Hello and a very warm welcome to this Master Investors March 2023 podcast. I'm delighted to be joined again by Jonathan Davis, author, investor, podcaster, teacher, editor of the Investment Trusts Handbook. So Jonathan, we're at the end of March, and what a month it's been in terms of the unexpected. UBS buying Credit Suisse, the all-share deal between FinCap and Senkos. It's becoming a very lean landscape.
Well, yes, we've seen the equity market's been shrinking for years, actually, which is not a good sign. But there's a lot of activity in the private equity space. But these mergers, well, I think we need to distinguish between the banks and the brokers. I mean, the banks, we've had, rumors or potential signs of a banking crisis. It's not just the merger between Credit Suisse and UBS, but also the troubles at Silicon Valley Bank and all the spin-offs from that. Which is exercising the regulators and the central banks a good deal, and not to mention investors. So it's been a kind of a month when, bad things look like they were about to happen, but in fact they haven't happened. The markets have stabilized. The banks, the bank shares, a lot of bank shares are still down a lot, but fears of a crisis seem to have receded a little bit. And in truth, it's a very different kind of crisis to what we had in 2008. It's more akin to the savings and loan issue that came up in the early 1990s, which was probably when you were still, toddling around in your school gear, Sarah. But there are always echoes from the past, but it is a worrying time, because if the banks get into trouble, then that has implications for the world economy and so on. As for the brokers, I think it's just a sign that business is tough. Business is very tough, both on the on the broking side and on the corporate side. It's in terms of volumes and so on, it's been a tough year, as we know, for the investors, and it's not a surprise to me to see some consolidation happening in the broking sector. Whether that's also going to spin out into the wider quoted market, I don't know, but it all depends how the economy goes from here. I'm still a little bit on the gloomy side, I have to say, about that, but others are more optimistic.
Well, I suppose we can be slightly optimistic in terms of we haven't seen a complete banking sector implosion as we did in 2008. I must admit, I was being a bit complacent because I wasn't being affected by, Silicon Investment Bank and UBS and Credit Suisse. I wasn't being impacted directly, but I suppose investors are being impacted by those undercurrents indirectly.
Yes, you are. I mean, one of the problems that the banks have, and Silicon Valley Bank had this, but lots of banks have it at the moment, is what's happened to interest rates. So interest rates, we know, have gone up very sharply in the last year, up to around, and gilts are up to about 3.5%, from virtually nothing. And as a result, a lot of people are finally waking up to the fact, well, their banks are still not paying them any interest on their deposits to speak of. And so they're suddenly saying, well, actually, I could take my money out of the banks and I can put it either into money market funds or into gilts or bonds or other types of bond. And they've been starting to do that. And of course, that means that the deposits that the banks have are going down. And that means that their ratios of assets to liabilities is also affected. And the big issue that Silicon Valley Bank and others have had is that it's all to do with bank accounting. It's rather boring stuff, but the assets that the banks hold in order to protect against liabilities and so on, a lot of those are in the form of government bonds, and government bonds have gone racking down in price because of the bond yields going up, and so the value of their assets on their balance sheet are much reduced at a time when they're also losing deposits. Now, you are allowed by the accounting practices not to mark down the value of a lot of your bonds if you say you're going to hold them to maturity. But if they did actually mark them to market, you'd find that the banks, the other side of the balance sheet, was also in big trouble. So there are issues for the banks here, and the fact that investors perhaps are not aware of what you say, but they are beginning to move their money out of banks to get a higher yield.
One of my other jobs is selling physical items, not selling from my portfolio, but selling items. So I do pay attention to what's going on in the Royal Mail, and I see a new postman every day, it seems, sort of more paperboy age. They're getting younger and younger. But I'm wondering what will happen if Royal Mail goes into administration, and what that means for the parent group, IDS?
Well, that's not one I look at very closely. I mean, you're lucky to see a postman at all. We have a very sporadic postal service in Oxford. It seems to be one of the epicenters of all sorts of trouble. They have the dreaded word reorganization has been heard around the place, which means that we see a different person when they do appear. But when they do appear, it's very sporadic. So kind of weekly magazines arrive. Sometimes they arrive the next day. Sometimes they arrive 2 weeks later. It seems to be entirely random. Well, yeah, but of course, the issue for the Royal Mail is they're putting up their prices all the time. I don't know if you've sent a letter to anywhere recently, but it's a pretty expensive thing. So basically, the letters business is shrinking and will go on shrinking, and they're still not making any money out of it. So basically, I don't think there has to be some kind of universal postal service that people can use. And effectively, it should really be supported by the state rather than by a private listed company, as IDS is now. And they want to get on with developing their international business. So it's a big problem. It's a sort of kind of the problem was, if you like, the buck was passed when the thing was privatized, but it hasn't really been solved. And I think it will go on that way. We'll all be forced to end up, for most things, we're going to use email and so on. So I don't know what it means for the company, but I'm sure they'd love to get rid of it if they could.
What did the budget mean for the likes of you and I, Jonathan? I mean, you and I are freelancers with a portfolio career. Because of March, of course, we heard from the Chancellor of the Exchequer.
We did, yeah, we did. And it was an interesting budget, I thought. I mean, the sort of bottom line is, as we knew from the mini budget last year, or the autumn statement, taxes are going up a lot. So, basically income tax is going up for two reasons. The stealth increases by virtue of freezing the allowances you get every year, and by general taxation increases in other areas. So basically, tax is going up in order to pay for all the debt that the government has, essentially, as a result of COVID and the war in Ukraine and supporting energy prices. Nothing is really for free. So we're all going to have to pay more for that. On the positive side, though, the ending the lifetime allowance for pension contributions will be helpful to a number of people, number of investors. It's if you get close to that million, or whatever it is, roughly million limit, then it has been a problem for a lot of relatively well-off people. That problem is been alleviated somewhat, though when you read the small print, the amount you can actually contribute and so on is not that much greater than it was. So that's positive, though. That's helpful. And of course, ISAs remain, and VCT regime remains, and so on. I was part of a seminar that Master Investor did about VCTs a couple of days ago, and it was very interesting. It's a kind of niche area, really suitable only of interest to, basically, I have to say, wealthier people, or the young. The young should be more aware about it. And that regime survives. So there are good news for investors, but against that has to be set the impact on the markets and the higher tax that we're all going to have to pay in the next few years, at least under the current plans. But as you know, Sarah, very well, everything changes. That's one of the problems with our system. They muck around with the pension system every year. They change it. They do this. They do that. They change the tax system every year. It's not what sensible countries should do, but it's what we have to live with. And for the self-employed people like you and I, as I say, there's always this end of year problems. I don't know what your experience is. Do you kind of do last minute ISA investing and trying to work out how much you can put into a pension or not? Is that an issue that you have to wrestle with at the end of each financial year?
I must admit, I'm pretty lazy, so I do tend to leave those kind of decisions right until the last minute, which of course isn't when you get the best deals. Because in previous podcast, you were advising me, Jonathan, that we should actually be making our financial decisions in the summer.
Absolutely. That, I think, is best practice, and mainly because the markets are often weaker in the summer, so you get better deals, but also, you can make more plans. Now, the problem the self-employed have, and I know this very well, and I'm sure you have the same experiences, in the middle of the summer, you don't actually know what your final year income is going to be. If you are a freelance and you do lots of different things like I do, and you do, you don't quite know what what your final income is going to be, and therefore you can't actually work out what the most tax effective decisions to make are. But in an ideal world, yes, I think the better way to do is either to make your sort of ISA and decisions and similar decisions in the summer, or do it on a regular basis. You just pay, so much a month into your pension or into your ISA, and hopefully it doesn't all go wrong at the end of the year. But that does. And if you're also involved in the VAT regime, which I've been involved in the VAT regime for many years, until quite recently, it's frankly a nightmare. It's an absolute bloody nightmare. I have making tax digital. I've been reading about that recently. We all, if you have a business or pay VAT, you have to use making tax digital. In other words, and you have to pay your people to help you do that. So that's another cost. And it just doesn't work in some cases. In VAT, in my experience with VAT and making tax digital has been an absolute nightmare. Combined with what happened during COVID, when all the systems went crash and no one could keep track of what was going on. So if I log into my making tax digital account for VAT, it says you don't owe any VAT to the taxman. And then I sort of do that, and the next day I get a letter from the VAT from HMRC saying you owe us X VAT, which I actually did owe. But there's no tie-up between what's on the Making Tax Digital platform and what was actually happening to your VAT, and there's no way of kind of putting it right. So it's a constant nightmare. It wastes a huge amount of time. I've had to have several calls with HMRC, which when you get through to them, which is usually not less than 3 days after you start hanging on the phone, you can have a sensible conversation, but it takes forever to get through to them. And even then, when they say they're going to do something, in my experience, nothing actually happens. One arm of the HMRC is not talking to the other. So basically, I'm a bit of a ranter about HMRC. Making tax digital for income tax, which is coming in, or at least has been threatened to come in, has been deferred yet again because by the government, because it is, making these kind of changes is absolute nightmare. We're not very good at it, I'm sorry to say. I mean, people talk about broken Britain and all that stuff. I think that's exaggerated, but we're just not good at doing these public, services that we should be able to do very efficiently. We're just no good at it, and it's very frustrating for lots of people. We all suffer, not always in silence.
That was a very gentle rant, but I think I'm with you. I'm not an ambassador of the VAT system. But going back to VCTs, for young investors who are not familiar with that acronym, venture capital trusts. So I know your webinar went on for almost 90 minutes yesterday. So what were the key takeaways?
Well, the key takeaways are, I mean, there's some questions about the VCT regime has been in place for a number of years, and it gives, basically essentially gives you tax breaks if you invest in early stage companies that could, possibly won't, but could become, the big names of the future. So it's designed to encourage support for new businesses, essentially innovation. And the rules when they were first introduced were pretty relaxed, and you could actually invest in all sorts of things which weren't very, very early stage. And the tax benefits include you get a 30% deduction from your income tax to the full amount of your investment. You get tax-free dividends, and you get tax-free capital gains as well. So it's all very attractive if the things actually perform. But the question is, has the sort of market changed? First of all, we've had a bad stock market last year, and listed technology shares have taken a real beating, as we know. Nasdaq's down and so on. So the question is, what happened to the valuations of VCTs and their ability to go on paying dividends, and also whether the recent changes in the budget are actually going to diminish the attraction of VCTs. Because if you can, for example, put more money into a pension because of the lifetime allowance being abolished, then that's an alternative to putting money into VCTs. Because most people who put money into VCTs are either retired people who use the income. The tax-free income is very helpful because you have to pay tax on your pension income, of course. Or for young high earners, they should be looking at this if they've got a lot of kind of spare cash, and if you're young and a high earner these days, you could be in that camp. It's a very good way to do long-term saving. So the question is, has it all changed the budget? The answer seems to be no. The attractions are still there, and they obviously it's the end of this financial year. There's only a few days to invest in the remaining VCTs. And apropos our earlier comment, you should be looking at VCTs earlier in the year, because the best ones have all closed already. They've done their offers. They're usually fixed amounts with a possibility of increasing it a little bit, and they've all closed, long since. So, but for the future, it does look like these tax benefits are very valuable, and of course, it's high risk, and so therefore it helps to have a diversified portfolio if you can. You can put up to 200,000 a year, so that would take up only some of your savings every year, Sarah. But if you've got a spare 200,000, I'd recommend a portfolio of VCTs to round out all your other things. I mean, the other point is you shouldn't have more than, say, 10% of your overall portfolio in VCTs, because they are very risky, but they do actually provide a very tax efficient alternative for higher risk, smaller company investment.
Yeah, I love your optimism about the amount of savings that you think I have.
I know, Sarah, you can't fool me. I know. That's no wonder you were worried about, Swiss banks and so on, because you've got your money stashed away in the mountains somewhere.
Maybe in the Alpine cheese, Asiago, a very good cheese. So we are coming to the end of March. And I remember, gosh, it was 3 months ago when you were saying to me, as January goes, so the year goes by, or something like that. And you had anticipated that the year was going to be a stormy one. I mean, so far we've seen a lot of cleansing and cleansing going on in the junior markets. A lot of very popular chief executives, they've gone. So it just seems as though it is stormy, and not just on a personnel level for some of the junior companies.
Yeah, absolutely. Well, it's not just junior companies. I think so goes January, so goes the year is an old market saying, which I think I was rather skeptical about when we spoke last time. That's if you're an optimist, that's what you rely on. I don't actually think that's how it's going to play out this year. I think we've got more trouble to come, just because this is one of these big resets that you get every so often, every 10 years or so, typically, and we haven't yet seen the full effect. Now, it is true that the equity markets have been okay this year. I mean, they've given up all the gains. Mostly, no, not all the gains. Some of the gains that they made since in January, but they're still kind of hanging in there. And bond yields have sort of seemed to be stabilizing, but they seem to have stopped going up because of the economy is still quite strong. So that's, if you like, good news. But I think it's just postponing the evil day. I mean, one of the mysteries is why the economy is still so strong after these big interest rate rises, which normally, and not to mention the higher energy prices, which would normally have an impact on the economy. And there's two reasons. That one is there's always lags between things changing and people actually adapting their behavior. So that's normal. Unemployment always lags things going wrong at higher interest rates and so on. So that's one issue. On the other hand, it seems to be there's still this residual effect of consumers. They got quite a lot of money actually out of COVID, government handouts and so on. And the help from the energy prices. So while there is a cost of living crisis, it doesn't seem to have reached consumers. They still seem to be spending a lot of money. And maybe it's a bit like, the cartoon character who keeps running off the edge of a diving board or whatever it is, and hasn't noticed that there's a descent coming. It's a fascinating paradox. The economists are scratching their heads, which is as normal, and people are on both sides of the argument. Some people say, well, it just shows we're not going to have a big recession and market sell-off, and others, which I'm more sympathetic, I fear, who think that it's still going to get worse when we see these knock-on effects. And what you're talking about is true. I mean, a lot of small companies will find that they are going to find it harder to borrow, or their interest costs will go up. A lot of companies may feel the need to merge. They're too small. In the investment trust world, which I'm very close to, that's happening as well. Consolidation between different funds because they're both too small or because they have specific issues. So, and if you walk down I was walking down. I was in London a couple of days ago, and was walking down, and you can begin to see, empty offices and things like that appearing again. I mean, we saw them during COVID, but appearing again. And these are all kind of, I have a fear, kind of straws in the wind of what might be coming. But as soon as we get through that, and who knows when that will be, it might be by the end of the year, we're going to see things are picking up again. So we might actually see things get a lot worse. And then by the end of the year, we can go back and say, well, look, in January, things went up, and over the year as a whole, they're up. But that will maybe be because we've been through a bit of a slump in the meantime.
Go on, cheer me up, Jonathan, because I know that you have a very exotic social life and you apportion some of your disposable income to great events such as the Oxford Literary Festival. What did Ian Wilson have to talk about?
Oh, well, that was interesting. Yes, I went to that last night, and it was fascinating. I mean, he started off first in True to My Memory way back in the sort of 1980s when he was a classic young fogey. If you remember the young fogies, he was like kind of Rees-Mogg of his day, very old-fashioned and very kind of pleased about doing so. But actually, he's a very good writer. He's written lots of fiction, lots of non-fiction, and he's kind of matured, I think it's fair to say, since then. So he was talking about his life, which was really interesting, and his parents in particular. His father worked for Wedgwood, the pottery maker, and it appears to have been a genuinely eccentric fellow who according to A.N. Wilson, used to, when he would go anywhere, he'd go into a pub, or he would stop people in the street and just start talking about his great passions in life, including Wedgwood and stuff. He literally engaged with strangers and just start bending their ear for a long time about things that interested him. So that was interesting. And then he also talked about, perhaps rather more darkly, about his experiences at a boarding school, private boarding school, which were quite similar to mine, I have to say. But I say unlike me, but there was a lot of, well, frankly, abuse going on, sadism by the teachers and so on, and it was a very traumatic experience for him. Though as I was lucky not to be involved in the abuse thing, but it was a very strange world, and it's long gone now because the private schools are regulated now. They were unregulated in those days. Can you imagine? You handed over your children to this small prep school or bigger, and they had complete control over your children. And kids didn't. I mean, the other thing he talked about was how, which I remember also, I mean, kids went back and they just didn't talk about it to their parents. They didn't talk about it to them. It was just too horrendous to talk about, and so the parents never knew until later what was going on. I mean, it's extraordinary experience, given how we look across all the point he made was look at all the institutions we have, the BBC, the Catholic Church, public schools, all these kind of old institutions, and how their instinct is always to sort of cover up what's going on. And it went on for years. And football clubs as well, we know there are a lot of issues there. It really is, I mean, shocking now in retrospect how that all played out. So he was talking about that and how he's kind of, how to deal with that and how he's recovered from it. So it was interesting. A little dark in that place, but it was interesting, and I enjoyed it. Yeah.
You did enjoy it. I was going to say, how is that going to cheer me up, Jonathan? But you mentioned Wedgwood. However, I did sell my Wedgwood recently, but every time I do that, it comes back into vogue. But Jonathan, we'll have to leave it there. So I think Jonathan Davies, the boarding school years, will probably be our next podcast conversation. But thank you very much. And of
Tales
course,
to tell. Tales to tell. But it's a lot better now. It's a lot better now. So if you want to be encouraged, it's all a lot better now, at least so I'm led to believe.
Yeah. And the final word should go to the Master Investor Show, because, of course, we had to delay it because of rail strikes. So the new date is Saturday, April the 15th. And same amount of speakers, same amount of energy. I'm looking forward to it.
So am I. I'm actually working on my presentation. I've got a 20-minute slot where I'm hoping to put the world to rights. And I'm hoping also to, last year I did it in harness with Simon Elliott, who's my co-host on the podcast, Investment Trust podcast, or was. He can't do that anymore, but he might be making a guest appearance as well as during my presentation. So I'm looking forward to it. I think it's a very interesting time in the markets. I mean, really is interesting. I'm looking forward to what Jim Mellon has to say. He was pretty helpful last year. I think most investors would agree. and I'm looking forward to having a chance to share my thoughts for what they're worth, and also, more importantly, meet again some of the many people who come up to me and talked about the Investment Trust Handbook or my other books or the podcast or any other witterings that go on. So I'm looking forward to it very much.
Yeah, me too. I've got Nigel Newton, the chief executive of Bloomsbury Publishing. So yeah, I think I might even have a better time than you.
Ah,
Thank
well,
you, Jonathan. I'll
I'd
see
be
you.
delighted if that's the case. Yeah, of course.
Thank you.